Hey, it's DJ Christopherson, Wisconsin's mortgage expert here, and kicking off a fresh new series on mortgage loan programs. It is by far one of the most common questions I am asked is, what's the difference between the different mortgage programs that are out there? Now, there are literally dozens of different things out there that people may have heard of, but we're really going to focus on the major ones. So I think we're going to make this series about 6 videos long, and today we're going to go over the FHA loan. Now, the FHA loan is one of the most common loans that we do, and there's a good reason for that. There are many different benefits of this particular program. But first, I want to kind of go over the different qualifications or the different features that a person needs to know about an FHA loan. Now, an FHA loan is only for people that are going to live in the property. So you cannot use this loan program if you want to use this as an investment property. Now, it is good for single families. It is good for 2 families, 3 families, and 4 families, but again, you must live in the property, and it is also available for some condos. Now, with the FHA loan, one of the best benefits of it, it's really geared for people that don't have perfect credit scores. Now, a lot of programs you're in here, 640 and higher, 660, but with this program, FHA, you can go all the way down to 580, and in some cases, you can go down to 560. Now, you won't find many lenders that will actually do that. We do, thankfully, but most lenders don't because they don't want, quote-unquote, the risk. And I really don't see any risk if you're able to pay your bills. And it doesn't really matter what your credit score is. It just matters if you're able to pay your bills. Now, regarding down payment, the minimum down payment on there is 3.5%. And that entire 3.5% can be gifted to you by a close family member, whether it's a cousin, aunt, uncle, mother, father, sibling, whoever it may be that's related to you. Now, regarding interest rate, now the biggest hot topic people talk about is interest rate. When they think about their mortgage loan, they want to know what interest rate they have. Now, how do interest rates come into being? Well, different loan programs have different rules on how they come up with the actual interest rate. Now, they're all market-based, but they look at a person's scenario, they kind of give them based on what they call risk-based factors. Now, the nice thing about FHA, they do not factor credit score nearly as much as a conventional financing does. So you're going to get a nice fixed interest rate with this program. Even if your credit score is 600, you're not going to have some astronomical rate that is, that nobody else is getting because they have good credit. So you're going to get a nice fixed interest rate. It comes in 30-year, comes in 25-year, 15-year. There are some ARM programs for it, but I really don't recommend that because interest rates are so good. Now, a few miscellaneous things you need to know about this program is that there is private mortgage insurance, and what people call PMI. Now, what is private mortgage insurance? Essentially what it is the buyer paid for insurance to refund the lender if the person was to default on their loan. So you're basically buying insurance to the lender. If I default, I have insurance to cover me. Now, with a conventional loan, if you have 20% down, you don't have to have private mortgage insurance, but with FHA loans, it's automatically required no matter how much you put down, and unfortunately, it is for the entire length of the loan. Now, if you're to refinance out of it, you can always do that, get rid of the PMI. And there's also what's called an FHA funding fee. This is not something that you pay out of pocket, it gets rolled into the loan, and this is a flat figure. Anywhere you go, it's going to be this. It's 1.75% of your base loan amount, and that gets rolled into the loan. So it is going to make your original balance a little bit higher to start things off. Now, one of the biggest things that people need to know about this, it has what's called an appraisal that needs to meet HUD guidelines. Now, an appraisal accomplishes one major thing to make sure the house is worth at least your purchase price. Now, with FHA loans, it goes a step further where it needs to meet specific, I'll call them cosmetic conditions. In order for it to qualify for FHA. For instance, if a house has peeling paint all over, it's not going to be FHA approved. Broken window panes, and it's missing carpets down to the subfloor. That doesn't mean that you can't get the property, it just means they have to be fixed prior to you be able to close. So that kind of makes, if you're looking to buy a big fixer-up or something, a lot of elbow grease, TLC, FHA loans probably not going to be the best for you. So I could go on and on and on about FHA loans. The actual guidelines are about as thick as a Bible, which is pretty crazy. But I wanted to give you the very basic, so you kind of know what you're going into. Maybe this is a loan that fits great for you, or fits great for somebody else. Now, next week I'm going to be talking about conventional loans, another very popular loan. So if you want to stay in touch, you want to get the next email, the next video in the series, make sure you click the link below, fill a little bit of information, subscribe to it, because then I'll be able to get it to you then, and you'll be the first to receive it. Until then, catch you next time.